Mortgage interest rates have climbed over the last few days to weeks. Why is that, and what needs to change in order for mortgage interest rates to come down? Hi folks, and welcome back to the channel. We know that the mortgage interest rates drive the housing market. After living through some of the lowest rates ever seen at 3%, mortgage interest rates are back above 7%. Why is that? Well, if you follow my channel for any amount of time, you know that the 10-year treasury is the thing that impacts mortgage interest rates the most. There's another piece of that too, and that's in the secondary mortgage market, or the mortgage-backed securities. But the 10-year is the baseline. In fact, let's talk about that for just 1 minute. In a world of finance, one key player often goes unnoticed: the 10-year treasury note. This unassuming piece of paper holds sway over mortgage interest rates. But how? Well, it's quite simple. When the yield or interest rate on the 10-year treasury note increases, lenders elevate mortgage rates to keep pace. They do this to retain their competitive edge and maintain a profit margin. Conversely, when the 10-year treasury yield dips, lenders follow suit, reducing mortgage rates. This is because the interest on the 10-year treasury is a benchmark for long-term interest rates, including those for mortgages. So next time you're eyeing that dream home, keep a watchful eye on the 10-year treasury. It might just be the key to unlocking a better mortgage rate. So here we see the 10-year treasury note today. This is 1 day, but let's go back 5 days. Take a look at the note. It's pretty flat. It stayed above in this range of 4.2%. Now, if you take that 4.2% and during high inflation, you can add about 3.2% to that to figure out where mortgage interest rates should probably end up. So with this would be at 7.49% or 7.5%. But since inflation has been falling in, I use that term loosely because what we have to think about is we're experiencing disinflation but not deflation. In other words, if we look at this simplified chart of inflation, we see that we hit a high during 2021 during the pandemic. It came down to 6.5%. 2022, 3.4% last year. And so far it's 3.1%. So you think, oh, that's good. Inflation is falling. But to understand what you're paying right now, you have to take all of these items and add them together. So if we go back to 2019, take the prices you paid in 2019 and 2020, and then add 7% to that for 2021. And then take that price and add another 6.5%. Then take that price and add another 3.4%. And then finally, take that price after all this inflation and add another 3.1%. So prices are going up, they're not going down, and that's where we really need to see some deflation if we want to get prices back down. And if we go back and look at the 10-year treasury during this period of time, we can see where it started picking up. January 2022, it's going up higher and higher, and this is just a 10-year. Now, you add again 3.2% to these numbers in order to find out what mortgage interest rates were during that time. And we get to this point where we're flattening out just a little bit. So we'll go back for just the last month. Take a look at the 10-year. We see back here, we hit a low point in February of 3.878%. Now, again, in 2024, we've had disinflation. And so that addition, instead of adding 3.2% for mortgage-backed securities, they've actually lowered their price down to about 2.8%. So when we take this chart and we look at 4.293, add about 2.8% to that, and you'll end up with your mortgage rates. Too much math? Okay, well, let's talk about it in plainer terms. And in those plainer terms, I want you to understand really basically what's driving that 10-year treasury. The treasury notes and bills that the U.S. Treasury Department sells at auction is meant to pay off our debt. The more debt we have, the more money we spend at the federal level, the more of those bonds they have to sell. Now recently they had a 20-year note sale that went poorly. And after that, it was on February 7th. After that, it's February 7th, we saw the 10-year and the other treasury notes start climbing incrementally. And one reason we see that is because, think about this. If inflation is sticky, and we saw that the consumer price index for last month came in a little hotter than expected, we would expect that the Federal Reserve, not the Treasury, but the Federal Reserve, two parts of this equation, will keep interest rates higher. And those are lending rates. Those have nothing to do with the mortgage. But that's what you're going to pay for a car or a refrigerator or other things in the economy. So if the Fed is going to keep the interest rates, the lending rates higher, then they're competing with the Treasury to get investors. If they keep that higher, think about your bank. Go to your bank or your credit union and find out what you can get for a money market right now. A lot of them are offering 5% returns on a money market. You have a 5% return from your bank or credit union, and over here, if you buy a Treasury, you only get 4.95%. So where are you going to put your money? Well, a lot of investors are going to stay over here, buy short-term bonds or those money markets, instead of investing long-term to pay our debt. So what happens for the Treasury Department? They have to raise the rate or the return on those bonds. So where we are at 3.875% back in February, early February, before the 20 years were sold, we now see we're at 4.295% because the Treasury Department is raising the return on those bonds and bills, and that impacts your mortgage rate. So what can you do about it? Well, there's only one thing we really can do about it. We have to stop spending so much at the federal government level, and we can control that through voting. Now, I'm not going to advocate for one side or the other. You pick who you want to vote for. But take a look at the people who are not going to promise you the moon and forgive debt and cost the American taxpayer even more money and create these huge deficits compared to others who might not. So locally, all politics are local. So if you have local politicians who are promising not to spend, long term, that's the better person for you. No matter what they promise you,
remember, nothing's free.
So that debt, if we keep increasing debt, we're going to keep seeing those bonds and bills go up, which means mortgage interest rates will continue to go up. It's pretty simple economics, and it impacts you directly in your pocketbook. It's a terrible trap that we're in where we have so much debt in our economy. We've got to get out of this mess long term, or no one's ever going to be able to afford a house again. We're at one of the points in history where housing is least affordable. It's a self-inflicted wound, and it's something we need to keep in mind. Now, in my next video, I'm going to talk about something else that the federal government is doing that is making it even harder for you to buy a home. So stay tuned. That video will be coming up in just a few days.